So all the speakers are going to speak for about 10 minutes, and then I'll ask a couple of questions using my chair's prerogative, and then we'll open it up to the floor. So without any further ado, Oliver.
Thanks so much, Allie. So my name is Oliver Lewis. I'm Director of Research at Vote Leave. I think any analysis of the single market has to appreciate that it's a very confusing concept, mostly because there's a lot of ambiguity about actually what constitutes the single market. As a concept, it actually incorporates a whole number of ideas and positions and policies. It's often used synonymously with free trade of Europe, and of course it's not. It also incorporates the customs union, there's concepts of mutual recognition, and crucially there's the concept of legislative harmonisation, and that's something I want to focus on today. It's a key feature of the single market, and my argument is that the European Commission has, over the last 20 years, used the single market as a rationale to drastically increase the amount of regulation across Europe, far beyond what would be needed for an effective free trade area. This is something that I don't think is controversial. Lord Cockfield, in his report in the 1980s, when he put forward the initial ideas for the single market, talked about how it would be a prelude to European unity. He also condemned the mediocrity, quote unquote, of the idea of just having a free trade area. The European Union has, over the last few years, used a legal basis for the single market in the treaties to introduce more and more regulations. These are often incredibly burdensome. They impact on business directly, holding back job creation and wealth generation. This, for example, would be the Clinical Trials Directive, which is one of those EU directives which is often cited by Eurosceptics as evidence of everything that's wrong with the European Union, and in my view quite rightly. It held back the creation of new cancer drugs, it has caused all sorts of problems for the research communities, but you can also go beyond just ad hoc examples. You can actually try and quantify the damage that the single market's basis in the treaties has caused. Open Europe did a very good paper last year when it looked at the 100 most expensive regulations that the EU has produced and are currently in force. This is based on the impact assessments which the government has done to quantify exactly how much they cost. What we did at Vote Leave was we went through all these 100 most burdensome and costly regulations, and we found that 66% of them had their basis in the single market's clauses within the treaty. So these actually stem from the single market. It equates to about £22.6 billion a year in costs for businesses. And when you consider the fact that the Commission has estimates of how much the single market benefits the UK via reducing the burdens to trade, in fact, if anything, it seems fairly clear that the costs far outweigh the benefits. The other thing that you have to remember is that the single market is designed primarily for exporters, and very few businesses actually export. This is something that Lord Lawson touched on earlier in his speech. Business for Britain did a study about 2 years ago which came to the conclusion that about between 5 and 6% of British businesses actually export to the EU. Amusingly, the Britain Stronger in Europe, the BSE campaign, a few weeks ago released some research which suggested that even less percentage of businesses actually export. Now, you can talk about whether or not regulation is a good thing or a bad thing. One of the things that you can't deny is that the UK has spectacularly failed to amend these directives. It has failed to change the direction of regulation. We have incredibly little influence. Lord Lawson commented again on the fact that the 72 times we have voted against regulations in the Council of Ministers, we have been outvoted. And I just want to build on that analysis. 40 of those 72 times have happened since David Cameron became Prime Minister. In short, since 2010, he has been outvoted more than all the other Prime Ministers combined. What we are seeing, in short, is the emergence of the Eurozone caucus. It's grouping together and voting down our views. So even if you don't take the view that us being outvoted in the Council is a good metric of our influence, I think it is, what the increased frequency of our defeat shows is that we are failing to exert our influence either directly at the Council table or behind closed doors. Now, the other element of the single market, which has been a big problem, has been that it also came along with the introduction of QMV and the expansion of QMV. Obviously, this was introduced via the Single European Act, which Mrs. Thatcher agreed to in 1986, and has been expanded since then. That loss of a veto has been, I would argue, devastating for us. The protections that we have been promised since then have proven to be ineffective. you recently saw George Osborne in 2014 make a speech where he acknowledged the fact that we couldn't stop regulations that were damaging the UK economy from coming in. And in his words, we will soon face a choice, either joining the euro or having to leave the EU. So I think that my argument is that the single market, because it has been the backdoor for a huge amount of regulation, has proven incredibly expensive. I think that it's far, far better that if we instead take control of the regulations that are introduced in this country. It's why I support the Vote Leave campaign. I think that instead we can create better rules for our businesses in this country. We can have a more democratic, accountable system. We will not have to introduce disastrous regulations such as the Clinical Trials Directive. I think that will also make us safer. But in terms of the overall question, just sort of rounding up my initial thoughts, does the UK get what it wants from the single market? Well, I think there's two other ways that you can measure whether or not we do. One is the polls. We have had various surveys and polls of business opinion, and they have overwhelmingly shown that businesses reject the rationale of the single market. If you ask businesses, do they agree with the proposition that in order to be able to trade freely with Europe, you have to accept the supremacy of EU law? The overwhelming majority of businesses, well into the 70s, reject that argument. They agree that we could have a free trade agreement with the EU outside, and you don't need to accept the full burden of the acquis communautaire. But also, as was suggested earlier as well, we are seeing a trend over the last few years of exporters moving more and more away from the EU. The EU is no longer the gold beacon that used to be for exporters. The exports to the EU are in relative long-term decline, and I think that's probably the best evidence there is that the single market is not working for the UK.
I would like to address this European Union membership issue purely from the banking and finance context. So it's a very narrow context. I'm going to try and do this in 10 minutes, and just banking and finance and industry makes that an extraordinary challenge. I want to look at the risks and opportunities from our ongoing membership strictly from the perspective of what's best for the UK, and just raise some of the questions rather than try and take a view. But first, let me start with a couple of preliminaries. First, is banking and finance somehow different to other industries that it warrants a special consideration? Well, first of all, I think the answer to this is yes. Banks as institutions are designed to take risks. There's no such thing as a riskless bank. But banks are also connected to the whole economy. And so when they fail, there's widespread consequences, as we all now know. And in extreme cases, there can be consequences for taxpayers. Second, is the UK somehow different to other EU countries that warrants a different consideration? Well, first of all, the UK is the largest exporter of financial services in the world. It's host to the largest cross-border banks. It dominates wholesale banking, insurance, asset management markets in Europe. So I think the fact that we have this very large market and there is always at least some tail risk, some risk to taxpayers, warrants that the UK does think about itself as an exception, and that gives a basis for having its own currency for maintaining sterling, because we always need to have that potential for liquidity support. So going now to the European Union question, membership provides us with access to the largest borderless market in the world, but the price is that we do give up our right to some independent action on certain, not all, but certain areas of financial policy. And the critical question is whether EU membership offers an opportunity to reduce the risks of being the global centre of finance, or whether it increases the risk. In other words, whether EU membership implies more risk for taxpayers' money will be used in bailouts or less. Now, just taking a step back, the greatest challenge for the UK being a global financial centre is the lack of international coordination between national regulators. As the former Bank of England Governor, Mervyn King, put it, banks are global in life, but national in death. And this problem hasn't been resolved. When banks fail, national governments always resort to national interests. So, 3 examples. First of all, with a non-European headquartered bank, Lehman Brothers, when on the 18th of September 2008, the Securities and Exchange Commission instructed Lehman US to close. Lehman International Europe, based in London, had no choice, so it had to seek bankruptcy immediately. There was something like 40,000 open trades that had to be solved. So the US acted on its own interests, and the rest of, particularly the UK, Europe had to take the consequences. What about in the European Economic Area? Well, we have another case there as well, IceSave, where a very famous case that the parent bank, Landesbank, decided they couldn't cover the costs of UK deposits, and the UK was forced to resort to terrorist legislation to stop, in order to freeze some assets of IceSave. In 2013, the European Free Trade Area ruled in favour of Iceland in that case, so we had no claim. Finally, the European Bank headquartered in Europe, Fortis, covered across Belgium, Luxembourg, France and Holland. When it failed, it was sorted out along national boundaries. So this is a very important question when you are a country like the UK that hosts very large, globally systemic banks. Now, it's not only in failure, also before banks fail, there can also be problems, or other financial institutions. We must remember that we have 2 of the 9 systemically important insurers are also UK companies. And ever since Walter Bagehot in 1873, we know that financial firms occasionally need access to emergency liquidity support, which is provided by central banks. If the UK is going to compete in global markets, it needs to have these contingencies. At the moment, the standard answer is we can arrange a swap agreement between the Bank of England and the ECB, and it will always be available under all circumstances. So an interesting question is, would that be available outside of the EU? And before we leave this point, swap agreements are not riskless. We actually had one between the Bank of England and the Bundesbank in 1992, and we know what happened there. So having some sort of international access to liquidity and resolution procedure, if you're going to be a global financial player, is pretty important. Now, getting back to the question of the European Union, is the UK more likely to reduce its risk as a global financial centre inside or outside of the EU? Since 2012, the EU has embarked on an incredibly ambitious programme called Banking Union to address exactly these issues around banks and taxpayer finance. Very much work in progress. It doesn't require joining the euro, and the UK has rejected the opportunity to join the banking union, leaving it these questions unanswered. By being a member of the EU, it raised the possibility that in the future, if influence can be brought to bear on the banking union, that the UK could help reduce some of its own risks. In other words, a more constructive approach might allow the UK to reduce some of its own risks. Now, of course, there's arguments against this. Skeptics would say, hang on, but we might end up also paying for the losses in countries like Greece or Spain, and that's not reasonable to our taxpayers because we have a different regulator. Well, in fact, in the Prime Minister's letter to President Tusk, he said taxpayers' money in non-Euro countries should never be used to support operations in the Eurozone. Now that sounds kind of reasonable. But again, I emphasise, as long as it's going to be a global financial centre, UK taxpayers will inevitably have exposure to countries overseas, inside the Eurozone and outside. So, for example, you'll all remember that Royal Bank of Scotland took over ABN AMRO, a huge Dutch conglomerate, the 15th biggest bank in the world, in 2007, just after Northern Rock. ABN AMRO turned out to be one of the worst banks in the world, of course. That became a loss to RBS, and that became a UK taxpayers' liability. In other words, yes, we did have exposure to a Eurozone country. It might not have been government to government, but it adds up to the same thing, the UK taxpayers' money. Another argument is for leaving the European Union is that financial policy will inevitably become divided, and this is what Oliver mentioned, this idea of caucusing between Eurozone and non-Eurozone countries, and the fact that the Eurozone countries now have a qualified majority in the Council of Ministers really means that they are the ones in charge of the rules. This was mitigated to a certain extent with the creation of the European Banking Authority, but now that the ECB is in charge of supervision and regulation, I think that that is more likely to lose power to the ECB, and so that again changes the game. There has been a case where agreements have been violated, the infamous case where a bridging loan was given to Greece, although the UK was not exposed to any losses. But again, I think it's important to recall that the regulations which are set in the European Union are first passed down from G20, they're then passed down to the Financial Stability Board and the systemic bodies, the Basel Committee and IOSCO, and then into Europe. And in Europe, importantly, the European Systemic Risk Board is a very important institution. Now, in all of these institutions, the UK already has tremendous influence. Mark Carney is the chair of the FSB. In G20, we play a prominent role. And the European Systemic Risk Board, Mark Carney is also the first vice president. So there is an argument that there could be more biasing of the rules in favour of the Eurozone countries. It's very hard to prove that that could never be the case, but it's up to the UK to use its influence to make sure that the financial regulations suit our own country, as well as, and that means providing financial stability for UK taxpayers. Thank you.
So we start with free movement of goods. We've heard a lot about it. In fact, with free movement of goods, it's a rather oversimple statement to say free movement of goods. It's more complex than that. These treaty provisions are essentially negative. You cannot tax, you cannot impose customs duties, and you cannot impose essentially technical standards on goods coming from other member states unless the state has a very good reason to do so, and most of the good reasons that the states come up with are not good reasons at all. The long and the short of it is that as a result of a combination of these principles, goods can move freely, and what's the benefit? Well, simply that. Think about what you ate in the 1970s, quite a lot of spam, and God knows what was in the spam. Think what we have now, think of the fact that your own kids talk about panettone as if it's something that they have every day, which indeed they do. And this is one of the reasons for that, is because these goods are freely available. What's the benefit? We eat decently. Now you might say, well, what about horse? Isn't horse an example of regulatory failure? Answer, probably not. The answer is it was a case of fraud, and fraud happens all the time, both pre and post joining the European Union. What's interesting now is the follow-up from this case of the horse meat in the burgers, is that actually the EU has strengthened its regulation. I'm doing some work on horse meat at the moment, legally rather than biologically, and but I have been talking to public health inspectors because it's not my area at all, and what they have been telling me very clearly is that actually as a result of membership of the EU, the quality of food safety regulation and the way we set about food safety standards has improved quite significantly. In particular, now there are veterinary inspections at every abattoir, and not just environmental health inspectors, so the inspections are done by qualified vets. So yes, free movement of goods, very important, and indeed we can bandy about statistics. There are a lot. You can see that the EU is basically the main trading partner, although there is a trade deficit in respect of free movement of goods with the European Union, but still for some sectors, particularly the motor industry, the success of the UK's automotive industry is, according to the Society of Motor Manufacturers, largely attributable to UK membership. Furthermore, on an international level, which I'm not going to talk about in much detail, but at an international level, the EU has over 50 trade agreements with which the UK obviously benefits. And the argument is that while we're in the EU, we benefit from being part of a big group and therefore easier to negotiate these trade agreements than it would be if we were a small fish, which we would be compared with being a membership of the EU. Would the US be interested in agreeing a TTIP equivalent with the UK alone? So that's goods, 2 minutes. Next 2 minutes on free movement of persons and services. That is the pillar which has been alluded to but not discussed so much today. On free movement of persons, what's it actually about? Well, actually, free movement of persons can be subdivided into 4 groups. You have a free movement of workers, and that's the capacity in which most of the EU8 nationals came to the United Kingdom. They have come here to work, and as they have come here to work, they enjoy equal treatment, both in terms of social benefits, including things like in-work benefits, like tax credits, and they also enjoy the same tax treatment, and they can bring their family members with them who may or may not be EU nationals. So we reckon there's probably about 1 million migrant workers in the UK, and probably about the same number of British nationals working in other member states under Article 45 of the treaty, who enjoy the rights of equal treatment with French, Spanish nationals in the relevant countries. Article 45 is supplemented by Article 49, allowing free movement of the self-employed. My taxi driver coming to the station this morning was Bulgarian, came here pre the Bulgarian full membership because he could enjoy rights of freedom of establishment as a self-employed person. But companies, lots of companies, got the right to set up in other member states or to come into the UK, or they can set up branches and agencies. And then there is free movement of services. Now this is hugely broad. It includes him, our Polish plumber, the Polish plumber who caused so much concern with the French, because the French saw a plumber coming temporarily to provide services would undercut French labour standards. But of course, to the French and to the British who are receiving the services of these plumbers, of course they are offering greater volume of service, so there's more competition on the market, and indeed greater chance of getting a plumber, which you might not have had before. Now with services also includes not just the economic freedom in the strict sense, but also the right for me to travel to a non-member state as a tourist. And this, of course, is the freedom that most British people who ever want to travel have exercised. The Ryanair effect of EU law. This is the right to travel from the UK to any other member state without any restriction apart from showing your passport. So yes, the UK benefits from this, UK nationals benefit from this. You only need to go to Stansted Airport to see the volume of Ryanair passengers who are taking advantage of their free movement rights. They probably have never given it a second thought that it is their free movement right, but that is where it comes from. And furthermore, if they get sick, once they go there, they will be able to wave their EHIC card in front of the noses of the equivalent of the NHS in those countries and get emergency healthcare treatment. They can also get planned long-term treatment under that. Mrs. Watts famously went to another country to get her hip replaced, and she could do it, according to the Court of Justice, because of her rights under Article 56 of the treaty. And then a lot of people move as EU citizens, and EU citizens include both students and so-called persons of independent means, i.e. people like Lord Lawson himself, who is no longer economically active, but is enjoying his rights of free movement in France, as he told us a number of times this morning, and he is doing that under Article 21, and of course this is reciprocated. It's not just British people going abroad, but it's also migrants coming here. So, big burning question, of course, is the benefits question. It is the political issue at the moment, but again, interestingly, we've heard from Lord Lawson this morning that migrants do not come for benefits, and certainly if you look at the question that Lord Kinnock posed in the House of Lords just before Christmas, the government could not produce any concrete evidence to show that the reason why migrants were coming to the UK was for benefits purposes, and the research that I'm doing as part of the UK in a Changing Europe project is to look at the motivations for people coming here. But what we can tell at very early stages, indeed, they are coming for work, and if benefits are available as well, great, of course, I'd take advantage of them, wouldn't you? And you can do so because of the principle of equal treatment. But remember, it cuts both ways. Migrants are getting benefits in the UK, but so are British nationals getting benefits when they go to other member states. And remember, there are about the same number of UK nationals in other member states as there are migrants in the UK. And you only need to go to the south of Spain to see more senior UK citizens enjoying the warm weather, the sun, the sea and the sand, and possibly not the other things. But that is a really important aspect of free movement. What are we getting from it? The UK is getting a lot. UK citizens are getting a lot. Last 2 minutes on free movement of capital, the fourth of the 4 freedoms. Now, capital is an odd thing because it's not about people going as such, but it's about investments in other member states. It might be your second home in France. It might be the fact that you've got rental income from property in other countries. And remember, it cuts both ways. It's French people who are investing in the UK. Now, with free movement of capital, it's a slightly different treaty provision because unlike all of the other treaty provisions, it is not dependent on intra-EU movement. It applies both for movement between EU member states and also outside EU member states. So there may be protection were we to leave the EU under Article 63, although again that's a slightly complicated legal issue. But free movement of capital is important because a combination of free movement of capital and free movement of services means, as we've already heard, in the financial services industry, it's extremely important to British interests. And indeed, as you can see, the UK is an attractive market for foreign investment, investors taking advantage of their rights under Article 63 of the treaty. And so were we to leave, that does also raise quite difficult issues, although, as I say, free movement of capital does apply to non-member states as well. But the entire financial services industry, at least part of it, is dependent on taking advantage of EU rights. So the UK does benefit from free movement of capital too. 10 minutes up, summary, overview of what free movement has done for us. Thank you very much.
So I just want to ask a few questions before we open it out to the floor. I'm going to ask each of the speakers a question, starting off with Oliver. I think one of the things that sometimes we make the mistake of doing is looking at single market membership through the narrative of exports, and from my opinion, exports are sometimes too narrow of a film to look at things through. One of the things that we found in our report, the idea was that there is a much wider array of commercial links in and people that are supported by exporters who support exporters. And so I'm wondering if you think that what consideration you give to the implications for people who actually supply into people who export, who maybe aren't counted as the people who would be potentially adversely impacted by Brexit.
I talked a bit about regulation and the burden that falls on it. The fact is that single market regulation applies to every business, whether or not they are direct exporters or whether or not they are in the supply chain. So I think it cuts both ways. You can say that there are companies which might not be picked up on the export figures or any analysis of who actually benefits from being able to trade with the EU, but also you have to take into consideration the fact that when these laws are devised in the European Commission for the purpose of easing trade between European countries, companies which have absolutely nothing to do with supply chain, or have nothing to do with exports, which are completely insular, that only engage in economic activity in their immediate area, also have to accommodate that regulation. So I think it cuts both ways in that respect.
And Angus, one of the things that we've seen in the last year or so is that this narrative has emerged that within the financial services industry in the UK, you have this divide between, on the European question, the big banks and sort of the hedge funds, people in sort of alternative finance industry. Do you think that that divide is as unilateral as people make it out to be when it comes down to how they look at the question of European Union membership?
Well, there's aspects of European regulation which, towards financial services, which have perhaps been, it's fair to say, been misconceived, particularly for alternative investments, which, you know, the initial argument when the crisis blew up was this is all to do with hedge funds, and we found out it wasn't. So I think nobody would say that all of this has been perfect. On the capital regulations for insurers, there's been some rowing back of the initial requirements. But on the other hand, you know, the UK, what does it do in financial services? It plays a very unique marketplace. It wholesale finance, derivatives, securities trading, which is very specialised work, which is very hard to. It's very high value added. It's very specialised. It isn't covered by many of these sort of more blanket regulations, and of course they're all mobile. Now, we've said many times in the past the UK could lose its leading position in financial services and so on. But I think more than ever, given the areas that the UK is specialised, securities trading and so on, and derivatives, that is probably a greater risk now than it was in the past, just because the type of business has changed.
Mm-hmm. And then, Catherine, one of the things that you hear about, particularly with respect to the European Court of Justice, we certainly shout loudly about it from a business perspective about what it's doing on the Working Time Directive, with the cases being brought before it. But I think there's sometimes another sort of side that's not always shown, which is where does the court intervene to protect freedom of movement of services, to establish services? Is that something that, because I know that the trade unions tend to shout very loudly about it, but doesn't seem to get picked up here as much?
So if your question is about does the court protect free movement of services, in fact the Court of Justice has been leading the way in protecting free movement of services. It's adopted a highly deregulatory stance, and it's essentially anticipated much of the Services Directive, which the UK was very much in favour of. The Services Directive is a dog's breakfast of a directive. It's not too bad on freedom of establishment. It's absolutely dreadful on free movement of services. It's incomprehensible. But the Court of Justice has adopted a very clear line that free movement of services, most restrictions outside the sectors of gambling and healthcare are unjustifiable. The trouble is, it's relying on the treaty provisions I've just been talking about is an inefficient way for any business to try and conduct its business, because there is a long time scale deliberately from when a case starts out in a national court to it ending up in the Court of Justice and then coming back. That's a really inefficient way for a business to challenge regulation. So once it gets to Luxembourg, there's every chance that a business will succeed outside those rather sensitive sectors in successfully challenging rules on services. The idea behind the Services Directive was that member states should screen their laws and remove those which interfered with freedom to provide services, something the UK did with vigour, because essentially a deregulatory agenda, which is what underpins the Services Directive, is very much coincides with the British approach.
One of the things that's important to understand in this debate is that there is no status quo option on the ballot paper. The European Commission has made it very clear that in light of the Eurozone crisis, there's going to need to be a lot more integration. And indeed, in the summer of last year, they released the 5 Presidents' Report, which set out a number of objectives for the coming years. And it does talk about the need to review tax. I think I'm right in saying that President Juncker, in his mission letters to the various commissioners, when he took office, said that this was something that needs to be reviewed. It's something the Commission has always looked at. It's not exactly a new idea. However, I think it's fair to say that coming out of the Eurozone crisis, with looking at a new treaty as a possibility, it's very likely that we will see this once again returned to the agenda. It's something that's been close to the Commission's heart for quite a while.
Angus?
Sure. So, first, for the Eurozone, because countries don't have a currency to make adjustments when they're required, and certain areas have slow development, then having a form of fiscal transfers is probably going to be part of what makes an eventual successful Eurozone. UK, of course, is not inside that, and so the pressures to be part of the same transfer system aren't as great, because we do have a valve to make our economic adjustments. It's called the currency. So I don't think this reads one-to-one across from what the Eurozone is doing to the implications for the UK, because of a different macroeconomic framework. Just a final point is that on the whole, if you were going to pick the taxes you're going to do, you should tax the least mobile of factors where there's not unreasonable to have different tax rates at all. It's only on the most mobile factors, such as corporation tax, that it starts becoming much more problematic, which is the point that you raised. But overall, the UK, we're a fundamentally different macroeconomic framework, although I would accept that part of the European Union solution will include transfers. It's not good enough to let Southern Europe, just like it's not good enough to let parts of north of England to have much lower levels of income and just say, well, that's your bad luck. That's probably not enough. The thing about services, distance doesn't really matter, because you can do it across border by a telephone. So it's what models are best for estimating those returns. And most of them estimate, when you look at services, the gains from being part of a trading group seem to be quite small for services because of the methodology that people are using. But if you put in things like membership of a political union or membership of a legal union into these equations, it actually becomes very powerful. So I think that we're just beginning to learn a bit more about how to measure this. But I support your concerns. And on the other issue, on financial services, the area that I'm interested in, it is telling that the US and Switzerland are the UK's biggest export of financial services market. But again, we have to be very careful. Why are those two markets? And it's primarily because of their large, systemically important banks being located in the UK, not just for the UK, but for the whole of Europe. So you have to be very careful what these statistics actually mean and how you put them together. But that's certainly a challenge to my own community, the economists, to try and make this as clear as possible.